Good afternoon. In recent months, it has become clear that the balance of risks has shifted. The combination of upside risks to inflation and downside risks to employment mean that there is no risk-free path for monetary policy. It is unclear whether policy should remain modestly restrictive to fight inflation or move closer to neutral to bolster employment. When the two sides of our dual mandate are in tension like this, our framework calls for us to balance both by evaluating which side is further from our long-run target. During today's meeting, we will examine current economic and financial conditions, including near-term projections, and weigh the risks to each side of the dual mandate in order to determine the appropriate policy action, beginning with a summary of economic conditions.
The pace of economic growth appears to have moderated in the first half of the year. Real GDP grew at an annualized rate of 1.6%, down from 2.4% growth in 2024. This decrease is primarily reflective of slowing consumption. Real personal consumption expenditures expanded at an annualized rate of 1.5% in the first half of the year, down sharply from 3.4% growth in 2024. Real final sales to private domestic purchasers also slowed, increasing at a 2.4% annualized rate that sits modestly below last year's 2.9% growth. While manufacturing activity continued to contract, with the ISM manufacturing PMI below 50 for the seventh consecutive month in September, overall industrial production has been trending upwards in recent months after 2.5 years of stagnation.
As noted in the September Bates book, however, elevated economic uncertainty led businesses to report reductions in expected investment across multiple sectors. In general, the weight of uncertainty was felt by both firms and consumers, resulting in reduced consumption and cautious outlooks for businesses. It is important to consider the impact of restrictive monetary policy risk stunting economic growth in ways that could hamper our goal of maximum stable employment.
The impact of economic uncertainty is reflected strongly in the labor market, where slowing in both supply and demand for labor in recent months has resulted in a less dynamic and somewhat softer labor market. The unemployment rate remains relatively low and stable, though the 4.3% rating in August represents the highest unemployment rate since November 2021. However, increasing unemployment among 16 to 24-year-olds and Black or African Americans, demographics which are both noted by committee members at the July meeting to be cyclically sensitive, may be indicative of risks of further softening in the labor market moving forward.
As noted in the July meeting, low and stable unemployment reflects a combination of low hiring and separation rates. Firms are hesitant to hire or fire workers due to elevated economic uncertainty, and workers are reluctant to leave their jobs voluntarily due to growing sentiment among the labor force that jobs are hard to find. This is consistent with the fact that though initial jobless claims have trended mostly sideways since the beginning of 2022, continued claims have slowly been rising and now sit at their highest level since February 2018, excluding the pandemic.
The labor force participation rate ticked up 1/10 of a percentage point in August to 62.3%, remaining solidly below pre-pandemic levels in a continuation of its downward trend since 2023. While prime-age labor supply has recovered above pre-pandemic levels, the supply of older and younger workers remains depressed and continues its downward trend observed in recent years. Furthermore, net immigration into the U.S. has decreased sharply in the past few months, further decreasing the available supply of workers.
The ratio of job vacancies to unemployed has been decreasing steadily from its peak in 2022, and in July it dipped below 1 for the first time since February 2018. The loosening VU ratio confirms that the labor market continues to soften as the effects of diminishing labor demand, reflected in low hiring rates due to economic uncertainty, outweigh the effects of decreased labor supply. Downward trends in the growth rate of real disposable personal income are similarly reflective of a cooling labor market.
The U.S. economy added 22,000 non-farm jobs in August, representing a general slowdown in non-farm payroll growth that has seen an average job adding rate of just 26,750 over the 4 months from May to August. A decreased break-even job adding rate, estimated to be around 40,000 per month, has meant that recent slowdowns in job growth have only had a minor upward effect on the unemployment rate thus far. Since January 2024, payroll growth has been led by strength in the private education and health services sector. However, growth has moderated in recent months. The story is similar for most of the other sectors driving growth. Job gains from 2024 have moderated, if not reversed, and sectors like the manufacturing sector that already observed job losses in 2024 have seen an acceleration in net layoffs.
However, the September ADP private employment report represents a weaker labor market than observed in BLS data so far. The report estimated 32,000 jobs lost in September and revised estimates for August downward from 54,000 jobs added to 3,000 jobs lost, bringing the average job adding rate since May down to 15,000 per month. Considering the recent decrease in government employment, combined with expected future government layoffs in the coming weeks, the outlook for job growth is bleak. Overall, though unemployment is low and stable for now, cracks starting to form in the labor market indicate that leaving monetary policy too restrictive for too long may risk excessive labor market deterioration.
Inflation has come down considerably from its post-pandemic highs, but still remains somewhat above our 2% target. PCE prices rose 2.7% in the year ending in August, a 0.1% percentage point increase from July, and a 0.3 percentage point increase from the year prior. Excluding food, volatile, and energy prices, core PCE prices rose 2.9% in the year ending in August, a small increase from July and about the same as a year prior.
Recent increases in core PCE inflation have been primarily driven by core goods inflation, while housing services continue to cool and non-housing core services inflation have remained steady. Increases in core goods inflation are driven almost entirely by tariff-sensitive durable goods. This indicates that much of the recent increase can be attributed to a one-time tariff-related price level increase. Furthermore, we estimate that housing services inflation will normalize over time as rents reset. As the Research Consumer Price Index for new tenant rent decreased in the year ending in Q2, and forecasts from Fannie Mae based on FHFA housing price indices predict a 2.8% rise in overall housing prices in 2025 due to a rise in housing inventory.
However, Supercore services inflation remained elevated at 3.3% in July, and we have seen no meaningful progress towards our 2% inflation goal in Supercore services since 2023. This implies that even if core goods and housing inflation come down in the medium term as we expect, overall core inflation will still sit a few tenths above our 2% target.
Additionally, consumer inflation expectations remain elevated at 4.7% for the next year and 3.7% over the next 5 years, according to the University of Michigan's August survey of consumers. However, these figures may be slightly skewed by overall economic pessimism, as reflected in the declining index of consumer sentiment. In contrast, market-based measures remain well anchored, with the 5-year break-even inflation rate at 2.38% and the 5-year forward inflation expectation at 2.28%. This is especially relevant as markets have largely priced in additional monetary easing, reflected in the future markets predicting an 83% probability of cuts in each of the next 2 meetings.
We now move to a summary of financial conditions. The National Financial Conditions Index has continued its downward trend since 2022 and sits at -0.56, signaling looser than average conditions in credit, risk, and leverage. In contrast, the Financial Conditions Impulse on Growth Index has trended lower in recent months, with August reading of -0.53 suggesting that current conditions are exerting a moderate drag on economic growth. This divergence underscores a growing asymmetry in policy outcomes. Capital markets are stable, but as we saw in our discussion of the labor market, firms are increasingly hesitant to expand payrolls.
Since Q2 of 2022, large U.S. banks have tightened commercial and industrial lending, peaking at 50.8% in Q3 of 2023 and settling at 9.5% in Q3 of 2025. This reflects a gradual normalization under a restrictive monetary environment, but sustained caution could constrain business investment and hiring. In corporate credit markets, yields have generally eased, with both investment-grade and non-investment grade corporate debt yields moderately below long-term averages. Spreads have compressed sharply, with high-yield spreads currently sitting at 2.81%, nearly half of the long-term average.
These tighter high-yield spreads indicate strong investor demand, but may also signal an underpricing of default risk. Lending standards no longer align with historical correlations, and recent bankruptcies in riskier segments like subprime auto lenders highlight emerging stress. Taken together, cautious bank lending and unusually low high-yield spreads paint a nuanced picture. Credit conditions are easing in some areas, yet vulnerabilities persist beneath the surface. This environment could limit investment and spending, adding pressure to economic growth and, by extension, labor market resilience.
Household balance sheets appear healthy on the surface, but in reality, they are much more fragile than they seem. Total household debt has reached $18.4 trillion, with credit card balances sitting at a record 1.2 trillion. Many households are paying down credit cards, improving leverage ratios on paper, but this reflects caution rather than strength. Stress is rising. 4.4% of household debt is delinquent, the highest rate since 2020, and credit card delinquencies are above 3%. Moreover, lower revolving balances give the illusion of financial strength, but many consumers are struggling and pulling back spending as a result.
Now that we frame the economic and financial landscape, we turn to policy. In keeping with our commitment to our dual mandate of maximum employment and price stability, and also in line with our assessment that the labor market is showing signs of deterioration, we elect to reduce the federal funds target range by 25 basis points, bringing the target range to 3.75% to 4%.
Additionally, balance sheet normalization will continue at its current pace. Treasury securities roll-offs will remain capped at $5 billion per month, while agency debt and mortgage-backed securities roll-off will remain capped at $35 billion. Maintaining this trajectory supports market stability, complements our rate decision, and allows us to continue reducing the size of the balance sheet. Finally, we remain committed to continued independence, transparency, and clear communication in order to effectively center any expectations of additional cuts.
As Governor Waller noted in August, labor markets can turn quickly. Prudence is essential. We must act proactively to stay ahead of layoffs, especially given the lagged effects of monetary policy. Prioritizing the labor market supports this approach.
We do recognize risks to both sides of our dual mandate, which present us with a challenging situation. Our framework asks us to focus on which side, inflation or employment, is further from its long-run target, taking into account current conditions and future projections.
Quantitative estimates of the real neutral rate, R-star, vary across models. The Holston-Laubach-Williams model places it at 0.8%, while the Lubick-Matz model estimates at about 2.1%. Adding our 2% inflation target implies a nominal neutral range of roughly 2.8% to 4.2%. While projecting R-star is inherently uncertain, these estimates suggest policy remains modestly restrictive but close to neutral, providing scope to support a cooling labor market without compromising progress on inflation, as long as we proceed cautiously.
Recent forecasts reinforce this balance. The August survey of professional forecasters expects 1.3% annualized real GDP growth in both Q3 and Q4 of 2025, up from May, while the Atlanta Fed's GDP Now model projects 3.8% annualized growth in Q3. Unemployment is expected by the SPF to rise gradually towards 4.5% through 2026, as core PCE inflation declines from 3% in Q3 2025 to 2.4% by Q3 2026. Taken together, these forecasts indicate continued disinflation and a softening labor market conditions, consistent with our earlier projections.
SPF labor forecasts should be interpreted cautiously. Downward revisions, around 70,000 jobs per month for the year ending in March, suggest payroll growth estimates for Q3 may have been overstated. While unemployment projections may be more reliable, this uncertainty reinforces the need for prudence in policy decisions.
With overnight reverse repo balances now near early 2021 levels, around $22 billion, short-term funding markets show ample liquidity, giving us confidence to continue our balance sheet normalization. Moreover, the $5 billion per month roll-off cap allows us to efficiently rein in the balance sheet while avoiding placing any unnecessary upward pressure onto Treasury yields, given current U.S. fiscal policy.
Overall, the policy stance remains appropriately calibrated to evolving conditions. Market-based inflation expectations are well anchored, underlying inflation continues to moderate, and early signs of labor market softening warrant a cautious adjustment towards neutrality. Reducing the federal funds rate by 25 basis points to a range of 3.75 to 4% appropriately balances the risks to both sides of our dual mandate while maintaining credibility in our inflation-fighting commitment.
That concludes our meeting. Thank you all in attendance.